Wednesday, August 31st, 2016. Monaco 64, home of alternative economics and contrarian views. This morning, I'd like to talk about zombie banks, the Keynesian fallacy, and creative destruction. Let's start out with zombie bank. Well, zombie bank was a term used quite often in the early 90s to describe the condition of the Japanese banks. There was a Japanese banking crisis in 1993, and I remember very well at the time all the major Western economists, the mainstream media, the policymakers in the West, they all criticized the Japanese government and finance officials for bailing out their banks, and they call them zombie banks. According to Wikipedia, it says a zombie bank is a financial institution that has an economic net worth less than zero but continues to operate because of its ability to repay its debts is shored up by implicit or explicit government credit support. What does that sound like? It sounds like our banking system now. You know, after the collapse of 07-08, we made the same mistake as the Japanese government. We bailed out the banks, and we're still bailing them out right now. What do you think? You know, negative interest rates, zero interest rates, QE. That's just to shore up worthless assets that were in banks' balance sheets and now are in central banks' balance sheets. So that's why the economy in the West is in a quagmire. Even the U.S. economy is in a quagmire. I don't, buy this thing that we're recovering, and who buys the unemployment rate that they publish. So that's a zombie bank. We've made the same mistake, as Japan. And Japan is still, for over 20 years, the Japanese economy hasn't recovered at all. I know there's demographics problem, but that's not the point. And with zombie banks, I'll bring up the theory of creative destruction, which was basically penned by Joseph Schumpeter, who was an Austrian economist. He later moved on to the U.S., but he was also a colleague of Felix Sommeray, who was an Austrian banker from the early 1900s. I've made videos about Felix Sommeray, and this is a very good book. And in his book, on page 136, and I quote, he talks about the time when Schumpeter was Ministry of Finance in Austria in 1919, prior to the great hyperinflation or great inflation. And I quote, he says, I had especially sharp disputes with my old classmate, friend Joseph Schumpeter, then Austrian finance minister, on the question of inflation versus bankruptcy. He implored me to organize a consortium in Zurich, the prime currency market of the continent, to maintain the exchange rate of the Austrian krone. I told him that was impossible. Austria's enormous state debt had to be liquidated either by a devaluation of the currency or by a total write-off. Schumpeter could not bring himself to contemplate the latter step because of its effect on the banks and special assurances that had been linked to war loans. But later, when the bank he joined after leaving the finance ministry collapsed, he ruefully admitted that I had been right. So there you go. Joseph Schumpeter learned by experience that you have to allow, in a free market, laissez-faire economy, you have to allow banks, companies, governments to, declare bankruptcy or collapse. Things change. And the Keynesian fallacy basically is that they can stop, the economy from going through, booms and busts, that they can use the government to control the economy. And that's what we've had, for the last 50, 60 years. And that's why we've come to a point that we are, the Western economies and governments are under so much debt because they've been using this Keynesian fallacy. And it's interesting to note as well that in the introduction of Keynes' general theory book, which is his main work, in the German edition, he says the following, and I quote, "The theory of aggregated production, which is the point of the following book, nevertheless can be much easier adapted to the conditions of a totalitarian state than the theory of production and distribution of a given production put forth under conditions of free competition and a large degree of laissez-faire." Laissez-faire just means free market economy with very little government intervention. And he goes on to say, "Although I have, after all, worked it out with a view to the conditions prevailing in the Anglo-Saxon countries, where a large degree of laissez-faire still prevails, nevertheless it remains applicable to situations in which state management is more pronounced." So there you have it. You know, that's what we're under now. A totalitarian Keynesian nightmare, and where, you know, central banks, governments, and big banks don't allow liquidation of assets, of malinvestments, and that's why our economies haven't picked up. The only country that has actually not followed this Keynesian fallacy is Iceland. I know it's a small country, population 300,000 or thereabouts, but actually when they had their crisis in 2009, they allowed all the banks to collapse. They nationalized the banks. They prosecuted the bankers. And and they defaulted also on their external debts. But now their economy has picked up. They've got low unemployment. Their GDP is like growing at 4 or 5%. Interest rates, they're, you know, not at zero, they're at 5 or 6%, and their economy is doing well. So that's what I wanted to talk about. You know, zombie banks, you know, they're making our economies zombie economies, and the central banks and politicians and the Keynesian economists, they're making a big mistake. Hopefully this system, you know, will implode on itself, and maybe we'll go back to more of a laissez-faire free market economy with smaller government. That will have to be seen. So there you have it. Zombie bank, creative destruction, and the Keynesian fallacy. So if you enjoy my video, please like, share, and subscribe. And you can also donate to my channel via Bitcoin, PayPal, or Patreon. The links are below in the description. Thanks for watching. Bye.